A very good afternoon to everyone. As we all know that financial reporting is an important tool in the hands of entity. It contains vital information about an entity's health. So financial reports are used by the stakeholders to track performance of an organization and also by the investor for taking the informed decisions. With this, I would like to welcome all of you in today's series of webinar on excellence in financial reporting, lessons learned, best practices, and commonly found error, specifically in today's session, which is around the public sector enterprises. We have amongst us the presence of the dynamic chairman of research committee, CA Dr. Anuj Goel sir, and the eminent speakers for today's session, CA Kuldeep Kothari sir and CA Ankit Maheshwari sir. So before going forward, I would like to briefly tell you about we also have amongst us Vice Chairman of the Research Committee, CA Kotha S. Srinivas sir. So I would like to give you a brief introduction about Vice Chairman of the Research Committee. Vice Chairman Research Committee C.S. Kotha Srinivas is a graduate from the Bangalore University and a fellow member of the Institute of Chartered Accountants of India and Institute of Cost and Works Accountant of India. He has also served the Institute for over 2 decades in various capacities. As a member of SIRC, he has brought in many initiatives, which includes conducting annual regional residential courses on residential international taxation. He has been instrumental in developing digital projects for SIRC, etc. Now, I would like to request C.S. Kotha Srinivas sir to please address the participants.
Thank you, Neha. Welcome all the participants for this particular web series of excellence in financial reporting. Also, let me welcome the chairman of Research Committee, C. Anuj Kumar Goel sir, and one of the today's speaker, Kuldeep Kothari is there. Ankit Maheshwari sir also has joined. Welcome to both of you, Kuldeep and Ankit Maheshwari sir. Neha is there, and all the participants who have joined for this particular web series. In fact, if you remember, we have been doing this series of programs started on 28th of April. We started with manufacturing sector. This basically is a series on webinar on excellence in financial reporting. So lessons learned, best practice and commonly found errors. We are very thankful and fortunate to have the 2 speakers who have been with us in all through the series. They've been taking us through what all the mistakes, generally mistakes that happen in financial reporting. We started with manufacturing sector, then we moved on to the service sector, then banking, insurance, then financial services, then we covered NPO and municipal body. In the last meeting, we had discussed about infrastructure and construction sector, and this meeting, they are taking us through this public sector enterprises. As you know, public sector enterprises, which plays a very, very major role in our economy. And we have C&AG audits for all those things. And we being the auditors, we also do start account a lot of audits, C&AG, the public sector enterprises. So today's webinar, the speakers will take us through the commonly found errors in these preparation of these financial statements, and also what are all the basic things one has to know while preparing the financial statements. So with these few opening remarks, I once again welcome all of you for this particular program. It's a series of programs. I think this is in this segment, I should say, this is the last program of this series. Definitely, we will plan other segment, and we will come before you in the coming months as such. So once again, welcoming all of you. Thanks for giving me this opportunity, Neha. Over to you.
Thank you, sir. Thank you for your valuable words. Now, participants, the research committee is blessed to work under the able chairmanship of CA Dr. Anuj Goel sir. And CA Anuj Goel sir is a practicing chartered accountant and the Central Council member of ICAI. He has made significant contribution to the profession with his extraordinary tenure of 17 years in Central Council, 3 years in Regional Council, 6 years in branches, including the chairman of various Central Indian Regional Council, chairman of various Central ICAI committees, member of editorial board, and so on. He is a self-motivated, enthusiastic, and hardworking person who has proved to be a great source of motivation and specifically for the youth. His contribution in the field of research and development has always been remarkable. Now, I would like to request CA Dr. Anuj Goel sir to please address the participants.
Thank you very much, Neha Bansalji. who is taking care of our various research initiatives through this research committee. I welcome CA Kothaya Srinivas sir, our Honorable Vice Chairman from Bengaluru. And we are, of course, having our very prominent resource persons. We are having Ankit Maheshwari sir and from Jaipur, and CA Kuldeep Kothari ji from Delhi, who are, of course, contributing like anything in the various initiatives of the research committee, and more particularly in this series of webinars. And today we would be covering the public sector enterprises. And as Kothaya Srinivas sir has rightly pointed out, that both of them have contributed in a great way in this series of webinars, which has helped not only the entities to see that how they can have the best practices in preparation of the financial statements. I think it is very useful even for the auditors also. So we are really blessed that we are having Kothaya Srinivas sir, our Honorable Vice Chairman, who is contributing in a great way to see that how we can really do something very concrete through this oldest technical committee of the Institute of Chartered Accountants of India. 1955 it came into existence, and these ICAI Award for Excellence in Financial Reporting. See the foresightedness of our leaders at that particular point of time, that in 1958 itself we thought it fit to see that how we can have ICAI Awards for Excellence in Financial Reporting. So more than 65 years back, we introduced this ICAI Award for Excellence in Financial Reporting, and we are trying our level best to see that whatever lesson we have done through these excellence awards, we are trying to share that knowledge with all our honorable viewers, so that we can have the best of the financial practices, best of the accounting practices as far as our corporates is concerned. Friends, today in continuation with the series of webinars, we will be covering public sector enterprises, and we are very well aware that public sector enterprises are one of the most important parts of the economy, particularly for our country. These enterprises help the government participate in the economic activities of the country. And you must be aware that in India, there are 365 public sector undertakings. Some of these PSUs come under the control of some of the ministries of the central government, like the railways and the other ministries. And 14% of the country's GDP can be attributed to the public sector in India. So it's a very vast sector. It encourages investment and generates capital by supporting the country's economy through the creation and expansion of infrastructure and creating other opportunities. I would like to mention that since 1958, as we are very well aware, that research committee through its subcommittee, the SEAL panel, has made extraordinary efforts to promote high quality financial reporting through this annual award competition, which this year we will be having in the capital city of Chhattisgarh, Raipur, ICAI Award for Excellence in Financial Reporting, in which entities are recognized for adhering to the sound reporting practices. Therefore, through this webinar on excellence in financial reporting, lessons learned, best practices, and commonly found errors, the ICAI Research Committee aims to build the capacity of all the members and to impart knowledge about the best reporting practices and highlight the common errors that are found in annual reports of various organizations. And friends, through this research committee, we are trying our level best to see that how we can be the leader, international leader as far as the research is concerned. And for the first time in the history of the accounting profession, we have come out with ICAI International Research Award. And in the time of Corona, we launched the ICAI International Research Award, and you will be very happy to know that on 19th of October, we will be having the ICI International Research Award in the Gulf countries, in Dubai, and the participants, the nominees from each and every part of the world have taken part in this ICI International Research Award. And through this, we really want to be global. In the very first year, second year, as well as third year, the IFAC president was the chairman of the jury. And that shows the importance of this ICI International Research Award. In addition to that, we have come out with the ICI Research Project Scheme, through which our honorable members are trying their level best to see that how they can use their expertise for the good of the profession, for the good of the nation. We do reimburse up to 10 lakhs of rupees for the ICI Research Project Scheme as reimbursement of expenses. In addition to that, we launched ICI Doctoral Scholarship Scheme, in which 75,000 rupees per month we are giving to the eligible PhD scholars who are doing PhD on full-time basis, and the topics are of the importance which will be good for the profession, for the nation. So we are trying our level best to see that how we can really do something very, very complete. Our vice chairman has given us a thought process that how in this 75th year of the formation of the Institute of Chartered Accountants of India, can we have 75 researches? So very religiously, we are trying to move in that direction, that in this 75th year of the foundation of our ICI, how we can really do something very, very concrete through this research committee, not only for the profession, but also for the nation. I will not be taking your further time, as we are very, very eager to hear our honorable guest speaker, C. Ankit Maheshwari sir from Jaipur, C. Kuldeep Kothari ji, who is a member of all the three institutes from Delhi. And I once again welcome all our honorable viewers who are present here from each and every part of the world. And I think the support which we got from all of you, I think it is something extraordinary. I once again grateful, indebted to Kothai Srinivas sir for being very, very active as vice chairman of this research committee. I am really grateful to Neha Bansal ji for contributing in a great way for the cause of the profession through this research committee. Thank you very much.
Thank you, sir, for the valuable insights. Now we have amongst us the eminent speakers who are a great source of knowledge and motivation for all of us, CA Ankit Maheshwari and CA Kuldeep Kothari ji. Ankit sir is a highly accomplished and dynamic chartered accountant with exceptional track record of over 15 years of professional experience spanning over various geographies. With a strong focus on enhancing financial reporting framework in India, Ankit sir has established himself as an expert in assurance. And we have amongst us CA Kuldeep Kothari sir. He's a fellow member of Institute of Chartered Accountants of India, and he's having expertise in the field of financial reporting framework and ESG reporting advisory, indirect and direct tax litigation, investment and startup consulting. He's also the author of various books and has delivered lectures on various topics like FRF, income tax, CST, etc. Now, I would like to request both the speakers to please start with the technical session today.
Thank you so much, Neha. I hope I am audible.
Yes, you are audible.
Yes, sir. Yes, sir.
Let me place my sincere thanks to CA Dr. Anuj Goyal sir for taking this entire initiative of having a series of webinars. And indeed, it is a big moment of concluding this entire series, which we started as the Vice Chairman, Sir Kothai Srinivas sir, told us about, starting it from 28th April to 4th August. There's a journey which we have been traveling together. Indeed, under his dynamic leadership, we are looking forward for the International Research Awards at Dubai. And yes, I think when we talk about the entire ecosystem of the research committee, Anuj Goyal sir has an immense contribution pertaining to it. Let me also thank the Vice Chairman of the committee, CA Kothai Srinivas sir, for relentlessly joining these sessions, guiding us through this. I would place my thanks to CA Kuldeep Kothari ji, who we have been jointly taking these sessions from the date of inception, and we jointly work together. Also, we make sure that whatever problems we face hands-on while evaluating the financial reporting frameworks of these entities, we bring out in these sessions. And lastly, the entire research committee, staff, and especially I would say the Secretary of the Research Committee, Dr. Amit Kumar Agrawal ji, for making sure that we are able to finally reach to some kind of an outcome through these sessions. Thank you, Neha. Thank you, Saloni. Thank you, everyone. And I will request Kuldeep ji to straight away share the presentation, and let's go on the technical side of the session. Today, we are at a very important juncture of discussing the public sector enterprises financial reporting frameworks. When we discuss public sector financial reporting frameworks, the sensitivity was already highlighted in the beginning of the session. What is important is the complexity of the financial reporting framework of public sector enterprises. This complex structures, the complex, accounting, the complex financial reporting framework, the annual reports, all these things we have tried to compile into this presentation. But before I go on, the common pitfalls of or the common errors we find in financial reporting frameworks of a company, I would straight away want to, make all the learned audience understand the quality reviewing mechanism of the institute. So when we talk about excellence in financial reporting, we need to understand that excellence can only be achieved through high quality adherence of standards. When we talk about high quality standards, we have to also understand the quality control mechanism of the institute. With regard to quality control mechanism of the institute, I have a question, and Neha, I would request you to help us in slight moderation also. We would want to keep this session extremely interactive. Can anybody in the
Sure.
learned audience, can anybody tell me the 4 very critical boards of the institute which monitors the quality of financial reporting in our country? And to all the audience here also, let's keep it very interactive. Webinars are generally very one-sided. I and Kuldeep always have tried throughout this series that we keep it interactive, receive our audience participation so that we are able to add maximum value to this. I am again repeating my question. Can anybody explain us the quality control mechanism of the institute with regard to the financial reporting framework? Kuldeep ji, if you receive any answer, let me know.
Sure, Ankit sir.
Because there might be a lag of 3, 5, 6 seconds.
Understand, sir.
Any answers as of now?
Not yet, sir.
Okay, let's go. Let's move on the next slide and let's start, deliberating around it, because we will be running short of time. Before we discuss the quality control mechanism, let me also set the tone what we will be covering today. So one, yes, we are discussing the quality control mechanism. Importantly, next we discuss the common pitfalls on financial disclosure sites or commonly found errors in public sector undertaking while preparing their financial statements and significant notes to accounts and estimates. Thereby, Kuldeep ji will have a detailed deliberation about LODR guidelines and compliances, and the change in the materiality concept which has come with effect from 14th of July 2023. And then we discuss the non-financial side of it, which is, in your annual report, in your financial report, what could be your, what should be an ideal chairman speech look like? What should be a constituent to a management discussion and analysis, corporate governance, sustainability report, and most importantly, today we would want to discuss the integrated reporting concept also, because while going through the annual reports, we see very few public sector enterprises, adopting integrated reporting framework. And finally, finally, we will conclude this session with some observations, commonly found errors reported by NFRA, National Financial Reporting Authority. So now we go on. If Kuldeep ji, do we still had any answers?
Yes, we have few answers. One is from BLN Pani Kumar from Hyderabad, FRRB, QRB, PRB, and tax audit. One is from Mr. Sumit Jain through QRB. Vikas Agarwal has answered IASB and FRRB. Nikhil Patel has answered FRRB. Ms. Aishwarya has answered NAFRA peer review mechanism. Mr. Venu from Mumbai has answered peer review. Madan Mohan ji from Bangalore has answered peer review, FRRB and QRB. And Mr. Om Prakash from
Fantastic. I think
Kolkata has answered
I
it.
think
Fair enough. The most number of answers that
I think
we
we
have
had got in any of the session. So yes, I think we almost everybody has come on the top answer. Only thing is that IASB or ASBs are not the quality reviewing board. Rest, I think majority of us has rightly answered, and we have to understand how these are monitoring us and what kind of impact it has on an enterprise and on the auditor of the enterprise. To make sure that your financial reporting framework is excellent, I think both the sides of the table, that is the auditor side and the auditee side, both have to, enhance together to make a quality financial reporting framework. So let's dissect these four boards. Let's look on to what a quality review board is basically about. In the quality review board basically monitors the quality financial reporting quality of the institute. In January 2019, institute lost its authority on this board, and NAFRA came up, and eventually now all quality review audits or QRBs are done through NFRA only, not at the will of the institute, which was earlier happening. So the quality review board is now totally adjudicated by National Financial Reporting Authority. With NFRA gaining a lot of significance, I would also want to highlight to all the viewers here. I think if you really want to enhance your financial reporting practices, you should look at FRQRB reports, financial reporting and quality review board reports of NAFRA. Constantly monitor the orders of what NAFRA is giving. NAFRA is constantly issuing advisory on financial reporting practices, and we should definitely look up to them. We should constantly make ourselves updated. But nowadays, no QRB is done, with the help of the only institute assist NFRA in, getting these audits done. But the entire prerogative is of NFRA. The other reporting board is a very important board, which is a parallel board of FRQRB, which is FRRB, Financial Reporting and Review Board. Financial Reporting and Review Board was formulated in 226th Council meeting in July 2002, with an intent in which to report to carry out or to inspect the documents of the companies in which public at large is vested. When we look at FRRB, we should understand one thing, that FRRB generally picks 8-10 companies at one time and generally look into the compliance of the professional and technical standards adopted by the company and by the auditor. So when an FRRB is done, you will realize that it is done for 10-20 companies and their auditors. And FRRB issues a report, a detailed report of very minutest non-compliances happening. Minutest to the extent that in case you are adopting Ind AS and you are presenting your cash flow statement and you are writing cash flow statement, so FRRB will highlight that kind of an observation, that a cash flow statement needs to be nomenclated to statement of cash flow, not cash flow statement. In certain cases, FRRB has found that cash flow from investing activities or operating activities or financing activities are interchanged. For example, your dividend income, your rental incomes, your interest incomes, they need to be appropriately disclosed. The methods of valuation of inventory, again, a pain point of FRRB, and whenever FRRB has done any inspection in respect of public sector undertakings also, these kind of things have happened. I have gone through FRRB report of Southern Ispat Nigam Limited also, and I am reiterating exactly the same observations which was in Southern Ispat Nigam Limited. So all these things needs to be taken care, and that is where I think we have to understand what FRRB's advisories are coming and make sure that we are complying to those observations. When you start reading that, you realize that a lot needs to be catch up to. There are basic mistakes from auditor side also. Now, Kuldeep ji, the problem earlier was that when any QRBs of FRRBs were done, the auditors of these companies used to get advisories. Now things have changed in last 5, 7, 8 years. You realize that all the auditors of these companies, when FRRB issue any negative reports or some qualifications or advisories, or even QRB does that, these all matters are taken to the disciplinary directorate of the institute, where FRRB becomes the complainant in this particular case, and the respondent is the auditor company. So there's to all those people who are auditors of these companies through CAG and everything, we have to make sure that the level of compliance of the technical and professional standards needs to be enhanced. That is something which is straight away coming out. The third board is the peer review board, and the chairman of the research committee himself is the chairman of the peer review board also. And institute took a brilliant mandate which SEBI took way back in 2010. In 2010, SEBI decided that the listed companies auditors needs to be mandatorily peer reviewed. However, in February 2022, Institute also took a mandate of getting the peer reviews done for almost all the firms, especially those firms which are doing AG audits, those firms which are listed. So if you are a 5-partner or more firm, initially when this mandate come, you were expected to get yourself peer reviewed by 31st March 2023. Now Institute took a deferment, and this deferment has gone to 31st March 2024. But AG also has taken care of this point only, that if you are continuously peer reviewed, then there is a maximum weightage which is given to the firm while empaneling through AG, which shows the sensitivity. As the name suggests, I think the activity is very clear. The work of the auditor is reviewed by his peer itself. And as similar to QRB or FRRB, the peer review also now any negative outcomes of a peer review can lead to a disciplinary action at the institute level. And that is why I wanted to discuss that, let's not only talk about the excellence, but let's talk about the bare minimum standard which this institute wants you to adhere to. The last is the tax audit and quality review board, with wherein audit is done by CBDT or on request of CBDT or on request of CBIC or RBI or even AG. All these special audits are undertaken by tax audit and quality review board. All these 4 boards are extremely critical in enhancing your financial reporting practices. All these 4 boards have open empanelments today. In case, like in FRRB, even members from public sector enterprises can also come and contribute. QRBs, PRBs, tax auditor and quality review board. As professionals, I think there's a lot which we can do together through these boards in enhancing the financial reporting frameworks of the entity. Kuldeep ji, anything you would want to add here? Else we move on.
Yes, sir, we should move on to the technical content.
Okay. So let's discuss, Kuldeep ji, one by one.
Yeah, sure.
The common pitfalls which we found while evaluating the financial reporting frameworks of public sector enterprises. When we talk about our first, I would say commonly found error through our experiences, it is the non-disclosure or wrong disclosure of market risk. I hope we understand the applicability of Ind AS 107. And when you read Ind AS 107, it defines all the kinds of risk which are available, right? The price risk, the other price risk, or you say the foreign exchange risk, or you say the cash flow risk or interest rate risk. All these risks are well defined there. The problem is when we have to categorize the market risk, lot of public sector enterprises are not categorizing it as per Ind AS 107, which says that these risks needs to be categorized into 3 risks. 1, the currency risk. 2, the interest rate risk. and 3, the other price risk. When we talk about these three risks are well-defined risks. When we talk about interest rate risk, Kuldeep ji, we found a lot of public sector undertakings writing cash flow risk. Yes, interest rate risk is a cash flow risk. There is no doubt about it. When you read the definition of interest rate risk, it defines that it is a cash flow risk. But the problem is that you can't change the nomenclature. And the idea of excellent financial reporting practices is not eventually your numbers will not change, but it is the communication which needs to change to the stakeholder, to the company. And it is the compliance to the technical standard. The second is the currency risk, which a lot of people write foreign exchange risk or something like that. And in none of the public sector company, Kuldeep ji, none, I found the word other price risk. Either people are writing commodity risk or people are writing price risk or some other risk, which is a replacement to other price risk. But importantly, we have to nomenclate it correctly, all these three risks. With this, also, I want to bring one more point on table. In case you are categorizing your market risk into these three risks, which is the currency risk, interest rate risk, and other price risk, an important thing which we need to do is the sensitivity analysis of all these three risks. So, Kuldeep ji, I would again come on the point that a lot of companies are doing sensitivity analysis of their currency risk. But I did not saw many companies doing sensitivity analysis, especially public sector enterprises, for their interest rate risk or their other price risk. It is mandatory as per Ind AS 107 to do a sensitivity analysis. In other price risk, if you are, see, other price risk is affected by two things. When you look at the definition of Ind AS 107, one is the price of the equity in which you are invested into. So if you have quoted equity instruments, you can do a other price risk sensitivity analysis based on the index of the stock exchanges. If you have a commodity risk, then also this risk needs to be, a sensitivity analysis of this risk needs to be done. So all in all, the first thing which we compliance is non-disclosure or wrong disclosure of these risks. Adding one step to it, I would say the sensitivity analysis also needs to be mandatory at Kuldeep ji. Else we can take the next risk.
Hey, Ankit ji, as you have rightly mentioned that this is one of the common pitfalls when you and I was jointly reviewing the financial reporting statements of the PSUs or say any private company also, Ankit ji. And to add on one thing, you mentioned about commodity price risk. Yes, it is part of the other price risk. The terminology has to be as per the Ind AS 107, which says that you need to categorize it as other prices, and then you mention the subcategories like commodity price risk or any other investment related risk if it is there. So in few cases, what we have seen, if you remember, Ankit ji, that the companies are presenting the commodity price risk, but they are not mentioning or they are not disclosing the sensitivity analysis of the same. And when questioned about the same, the management or the financial reporting team told us that it is not possible for them to categorize or to present the sensitivity analysis of the commodity, and it is, and then we have given them one example of that commodity price risk, that it is very easy. You need to do just two things. That say for any manufacturing entity, there are few raw materials which are of significant importance. So you need to present that whether a change of 5 or 10% based on the decision or the sensitivity that the company is following will impact the profit and the profit after tax of the EBITDA of the company in a way, and the compliance is made. And the other issue that you have mentioned, the sensitivity analysis is it is clearly given in the para 40 of Ind AS 107 that for all type of market risk, the sensitivity analysis has to be presented by the company. If you are identifying any sort of risk, be it a currency risk, interest rate risk, or other price risk, including the commodity price risk, sensitivity analysis is a must, which is required to be given. So moving on to the next common pitfall, it is also related to Ind AS 107.
Kuldeep ji, I would just want to add one more
Sure.
thing in this. Sorry, there could be a
No, no.
price lag because I am at a very remote location. There
Mhm.
could be a voice lag. In case of, while we were discussing other price risk, I talked about quoted equity instruments. I
Yes.
would just want to correct slightly. Even unquoted equity instruments needs
Exactly.
to be categorized into other price risk. So in case if there is any company which are any public sector enterprises holding unquoted securities also, right? A sensitivity analysis needs to be done for the same. Next, Kuldeep ji, you can take the point.
Yeah, sure. So the next point is related to reclassification of financial asset. So Neha, please, if you see if there is any answer to this question, I am putting up this question for the audience that in your understanding, whether if there is any reclassification of financial asset, first question whether it is possible, and second, if it is possible, what all disclosures are required to be given. As per Ind AS 107 and 109, if you make any reclassification, whether it is permitted as per the Indian accounting standard. And the second part of this question is, if it is so, then what all disclosures are required to be made.
So no responses yet.
No responses. So Ankit ji, we are moving on to the.
It will take some time. You can take one more risk. In meantime, somebody can respond on this answer.
Okay. So do we have any answers?
You can repeat the question once more, and let's move
sure.
on the next point.
So this particular question, it has two parts. One is that whether reclassification of financial asset is possible or permitted as per the Indian accounting standards. And the second part of this question is, if it is so, then what all details are required to be disclosed upon such reclassification. Any answers?
Perfect. I think the question is clear.
Yes.
Not yet, sir.
We can move on the next pitfall, and we will come back on this again.
Sure.
It's a very interesting question.
So the next we have already covered. It is related to the sensitivity analysis. The next commonly found pitfall, Ankit ji, is related to Schedule 3. As we all know that in 2021 March, MCA came with a notification, and the disclosure related requirement of Schedule 3 was amended to a larger extent, and it requires the company to show the intangible assets under development to be shown separately on the face of balance sheet. And what we have seen while reviewing such financial statement, Ankit ji, that many of the companies or many of the listed companies were showing it along with the property, plant and equipment schedule, and it is a wrong. Though the error seems to be very small. Error seems to be very small, but it has greater implication, as you mentioned, that while the disciplinary proceedings or FRRB proceedings were initiated upon using of wrong nomenclature for Ind AS 7 statement of cash flows and cash flow statement. Likewise, for this intangible assets under development, it seems to be a small presentational error, but it has a greater implication. So before moving forward to other commonly found pitfalls of Ind AS, I would like to cover a few commonly found pitfalls related to Schedule 3, if you permit, Ankit ji. Can I cover?
Kuldeep ji, definitely you talk about Schedule 3, and I would talk about Ind AS 38 intangible. There are certain pitfalls in disclosure pertaining to Ind AS 38 also. So let's discuss it here. But did we got the previous answers? I am very interested to know.
Sir, we have one answer from Pooja Kukreja Pune. Yes, reclassification is possible.
Kuldeep ji, first let's deliberate on it and then,
Yeah, sure.
or you want to finish this and then come on it,
No,
whatever.
no. Let's deliberate on the reclassification part. Yes, Pooja, you are right. Reclassification
So
is
we have-
possible. Yeah.
Like we have few more answers from Shrikant. Yes, reclassification of financial assets can be done when there is change in business model. The impact due to reclassification in the financial statement, the justification of the change in reclassification.
Exactly, you are spot on, Shrikant ji and Pooja ji. Reclassification is possible, though it is not a journal event, as you have mentioned. It is only possible on account of change in business model. But yes, it is possible. So whenever there is a reclassification, I am giving you a practical example of from the extract of a financial report. First of all, the entity was classifying the financial assets on amortized cost method. I think we all are aware about amortized cost method. When you invest into financial assets or financial instruments, so if you are holding that particular asset for solely for the purpose of payment of principal and interest, in that case you value that particular asset on amortized cost method and you account for the same as per Ind AS 109. But in this particular case, what we have found is that the company was valuing a financial asset on amortized cost method, and later on they changed the method to fair value through other comprehensive income. And later on there was a change in business model, and the company decided that due to the change of business model, the financial instrument is to be valued at fair value only, but the impact is to be passed through profit and loss account. If you guys are aware of the fact that what is FP through OCA and what is FP through P&L, when there is any such reclassification or the impact of change of value of financial assets, the impact is directly parked into or parked through profit and loss account. It is FP through profit and loss account, and when it is put in into a separate account, which eventually will be reversed and will be passed through profit and loss account. But at first instance, it is parked in other comprehensive and it is below the line item. So in this particular case, the company changed the method from fair value to fair value OCA to fair value PL. But when we were going through the disclosure part, the company failed to disclose the same in accordance with para 12B of Ind AS 107 and para 441 of Ind AS 109. Para 12B of Ind AS 107 clearly says when there is any change in classification of any financial asset, so you need to mention what is the classification, what was the classification in the previous reporting period, and what is the classification in the current reporting period, what is the reason of change, what changes occurred on in the business model which has resulted into change of classification of financial asset. As rightly mentioned by one of our audience, Mr. BL Pahani Kumar, that both qualitative and quantitative disclosures are required to be made, and the impact of such reclassification in each category of financial asset is required to be mentioned. Anything you would like to add, Ankit ji, on this, or we should move on to the next commonly found?
No, I think you have exhaustively deliberated.
Because Ankit ji, one thing I would like to add on to this particular point, that while evaluating so many reports as a technical reviewers of the institute or jointly working on financial reporting framework of the companies, what I have personally seen, and I believe that you are also of the same opinion, that the major issue is there in disclosure part, the accounting policies and the way they are describing
Correct.
the notes to account. The major pitfalls are there in the disclosure and accounting policy part. So moving on to the next.
Correct, Kuldeep, it is just not possible to look at the numbers. You from institute point of view also, and from the point of view in case we have been working on enhancing the financial reporting framework of these organizations.
So Ankit ji, I would request you to deliberate upon that Ind AS 38 intangible assets you were mentioning about when we moved on to the Ind AS 107 part.
So just two things before you go detail into schedule 3. One, the intangibles, when you write the policy of intangibles, right, we should classify these intangibles on both finite and infinite lives. So your intangible needs to be classified accordingly. Also, a lot of public sector undertakings are giving the lifespan of the asset, but not giving the remaining useful life as per the disclosure requirements. So these are two things which we need to take care. Lastly, in case there is an impairment testing, right? So your impairment testing for property, plant and equipment will differ from the impairment testing of the intangibles. So a lot of companies, right, we do our impairment testing on quarterly basis. However, when we look into their financial reporting frameworks, we find they do it on annual basis. So the policies of intangible needs to be in compliance with the practices which we have or the accounting SOPs which we have made. Now over to Kuldeep ji for deliberating on other points of Schedule 3.
So Ankit ji, as we were discussing while going through so many reports of the financial statements of the companies, I have summarized few commonly found pitfalls which was there in almost every report. If you remember, first is related to statement in changes of equity. So the Schedule 3, the amended Schedule 3,
Correct.
it clearly requires you to mention or to include if there is any changes in equity share capital or the other reserves or the other equity on account of prior period errors or any reclassification. So if it is any reclassification or prior period errors are there, and due to which there is an impact on the equity share capital or the other equity part, then you are required to include it in the format of presentation of statement of changes in equity itself. But vice versa on the other side, Ankit ji, that if there is no such impact, the Schedule 3 requires you to disclose that there are no such errors due to prior period, there are no such impact due to prior period errors and reclassification. And I would request the audience to go through the guidance note of the institute on Schedule 3.
So I think Kuldeep ji.
Yes, sure, sir. Please, sir.
But just I was referring to the guidance note only. The commonly found error is not disclosing this, is not able to give a positive assurance that there are no changes in the prior period items.
The second, Ankit ji, commonly found pitfall was related to presentation of capital work in progress or the projects which are under development phase. So the amended Schedule 3 clearly requires you that if there is any delay in the project cost, if there is any delay in the completion timeline of the project when compared to the original cost, point number 1, and point number 2 is if there is any excess of cost as per the original cost schedule, as per the original plan of that particular capital implementation project, you need to disclose it. Again, Ankit ji, the same issue arises if there is no such delay or if there is no such overrun of cost or the timeline which was given as per the original schedule, then you need to give the positive affirmation that yes, there are no such delays on account of cost and the completion timeline when compared to the original cost. Ankit ji, you would like to add anything to this particular point?
No, I think an excellent financial reporting framework can only come out once you start giving positive assurance on things. We just not have to report the negative or where there is a change or where there's an impact. Even the new policy of materiality talks about the same. That if there is something material but not happening, also needs to come on the face of the financial reporting frameworks of the company. So I think perfectly said. Let's move on the next point.
The next point is very common yet very commonly found error and very simple point. It is relating to aging of debtors and creditors, Ankit ji. the amended Schedule 3 again clearly requires you to, mention the aging as per the requisite format which is given here, which is given in the Schedule 3. But it also says that the total of that particular aging schedule should match with the total of the debtors and creditors, which is mentioned on the face of the financial statement. Yet we have seen in many of the companies that few kind of errors over there. Say if there is any invoice which is issued but it is not due for the payment, they are not disclosing it in the aging schedule, and vice versa. There was one point, and we commonly ask questions in our few previous seminars. It was related to the disputed trade payables. So disputed trade payables are also required to be included in the aging schedule of sundry creditors.
Correct.
And vice versa, if there is any invoice which is issued but it is not yet due for the payment, you need to include it in the aging schedule under that particular tab, that not due for payment, because the guidance note of the institute clearly says that the total of the sundry debtors and creditors on the face of the financial statement should match with the total of the aging schedule. Anything you want to add on to this, Ankitji?
Right. Only thing I would want to reiterate your point once again. Even the largest companies like Reliance, if you look at their last, annual reports, they were not able to, match to their aging schedules. And eventually, it took us a lot of time to convince the managements of these companies to come out with the exact total of the aging. Generally, the practice these companies follows is that they only present their aged debtors, right? And they do not take it into the unaged debtors, or I would say the debtors which have not been outstanding, right? They are not taken care of. So make sure that this match, even if your debtors or creditors are not outstanding. That's all.
The next, Ankitji, again, it is a very commonly found pitfall which we have seen, and I think you would appreciate this. It is related to ratio analysis. So the amended Schedule 3, mandated for the companies to disclose 11 such ratios, which was given in the amendment notification. And along with that disclosure of ratios, the companies are required to give the reason for any change of ratios compared to the previous reporting period if the change is more than 25%. So, Ankitji, if you remember, what we have seen in one very big listed company, that previously, before implementation of this amendment notification related to Schedule 3, the MDA, Management Discussion Analysis section, which is the most important part of an annual report, and which is the most forgotten, I think, disclosure what we have seen in the annual reports, it required the companies to give 7 ratios, and this 25% deviation requirement was there also. But previously companies were not disclosing or giving such ratios in the MDA, and one big company has received SEBI notice also in this particular point. And when we come to the amended schedule, penalty notice.
Not notice. They were imposed a fine.
Yes.
They were imposed a fine.
Correcting myself, they were imposed a fine. And when you come to the amended Schedule 3's requirement, it requires you to give 11 ratios, and the institute has come up with the guidance note, and it has defined also, because see, for the first time this disclosure related requirement was pushed to the companies, and to make sure that there is uniformity in reporting, because the ratios, though the formulas are almost uniform for calculating the ratios, but the way of presentation can be different. So the institute has come out with specific formulas and the presentation related details in the guidance note. Still, what we have seen is that the companies are not disclosing it in the uniform way, not disclosing it accordingly in accordance with the guidance note of the institute. And third, Ankitji, when you talk about the reason of that 25% deviation, so what we have seen is that you are just writing that if there is any change in debt and equity ratio, due to the change in debt, the debt equity ratio change. It is not the reason. It is state of the change, or state of the particular ratio. It is not the reason of the change. And I would request you to cover the next commonly found pitfall related to Schedule 3, which is related to mentioning of the reasons if the assets are not held in the name of company. Ankit sir?
Correct. So, am I audible?
Yes, yes. I would like you to take this last commonly found pitfall. It is related to assets not held in the name of company. The reasons which are required to
So
mention
it
for assets.
pertains to right.
Hmm.
So assets. So the problem is not the asset which are not held in the name of the company. The problem pertains to the title deeds. While we write the reason that why a title deed is not in the name of the company, right? The reason needs to be a justifiable reason there. So sometimes, I can give you example. If there's no title deed in the name of the company, so people say pending at uh, the state authority or pending at the entity which will do the lease with you. So that doesn't solve the purpose. For 4, 5, 6 years, you can't write the same reason. Pending or pending with the authority is not the reason. Why is it pending should come out? And that is again a better practice which we need to follow. Again, I would say, it is the most commonly found error. Just the status writing pending or writing a generic statement would not do. The interaction with the stakeholder is critical. The reason for pendency for such title deed for number of years, as the number of years increase, please enhance the reason also. And if it is a material asset, then the reason needs to be a better reason by just not merely stating 1 or 2 lines on it which are generic. That is I hope, Kuldeep ji, you were discussing on the same thing.
Yes, exactly, Ankit. So I think we are done with the commonly found pitfalls related to Schedule 3. There is one question or one point from Mr. Viral Agarwal. PPT is not getting changed, and sir, the all pitfalls related to Schedule 3 which we have discussed right now, they are not mentioned in the PPT, but they are based on our personal experience, practical experience, which we have seen, which we have gathered while reviewing the reports of the entities, be it a PSU or be it any other private entity. So Ankit, can we move on to the next commonly found pitfall?
In case Viral ji did not got, because since there was no video for these errors, Viral ji, you can please write on the chat box. We will again come on the
Yeah,
same
sure.
point which Kuldeep ji has written if something is been missed. Rest all points you will see through the slide. This is something he just added up between the presentation he wanted to discuss. The next point, Kuldeep ji, if we can change the slide.
Yes. It is related to initial recognition of trade receivables, Ankit ji. I think it is
Correct.
you are
So
going to
this
take this
comes
point.
out. I think now everybody sensitized post 29th March 2023
Yes.
advisory of NFRA, where the the initial recognition process of trade receivables. Lot of companies were quoting that they are initially recognizing these trade receivables on the fair market value. However, while these trade receivables did not had any significant financing component, they need to be recognized it as per the transaction cost. I hope this is clear, because whatever NAFRA orders you see in last few days, or whatever NAFRA investigations, or I would say quality reviews, what NFRA has undertaken, this is one of the top points, that the recognition of trade receivables. Kuldeep ji, also I would want to correlate it to the non-disclosure of provision metrics and using the simplified approach method and determining the expected credit loss based on the lifetime metrics. There are two commonly found errors, and Kuldeep ji, I would want you to back me up for this.
Yeah, sure.
One, lot of companies in their accounting policies are talking about recognition of trade receivables as well as impairment of trade receivables. But on impairment of trade receivables, we found, or on provisioning of trade receivables, we found the problem is that these companies are writing that they are using the simplified approach method, and thus they are not doing their credit assessment. So using simplified approach method does not exempt any company to not do a credit assessment. A credit risk assessment needs to be done irrespective. And if there is a change in this credit risk, then you can't even follow a lifetime method. Then you can't even follow a simplified approach. So point here is, please make sure your accounting policies, in case all PSUs, corporate reporting teams are there, please review this statement that since the company is using a simplified approach method, thus it is not assessing their credit risk. This is a incorrect statement as per Ind AS 109. So make sure that this is done. Another thing, I have not seen, as of now, to my experience, I have not seen any company disclosing their provision metrics, which NFRA also advised in the circular dated 29th March, that it is mandatory to disclose your provision metrics based on whatever impairment allowance you see out of your trade receivables. Kuldeep ji, since this point is discussed, and I had this discussion, Saloni has also joined. I had this discussion in Saloni when we were compiling the compendium. Kuldeep ji, I have this question to our audience.
Sure.
That whether, so a lot of people are writing about impairment allowances of their financial instruments, right? They define their financial assets, they define their financial liabilities as a part of their policy. Now, people talk about the financial instruments in terms of equity debt they are holding, right? They talk about the trade receivables, but a lot of companies don't talk about the other contractual assets, and a lot of companies don't talk about the deposits. So the deposits which your company is having, my question is it necessary to provide an impairment allowance or an impairment policy pertaining to fixed deposits or even their bank account? Is it required to be impaired? I will make question more clear. In your accounting policy, is it required to disclose an account impairment policy pertaining to fixed deposits, pertaining to bank account, pertaining to other contractual assets? And in case your bank account is with any public sector bank only, then also is it required to have a policy of impairment allowance? I just need an answer to this. Kuldeep ji, in meantime, we can move on the next point.
It is related to related party transaction, Ankit ji.
Okay, you can do the deliberation.
Before we move on to the next point, if you permit me, I would like to add few things to this initial recognition of trade receivable point and provision matrix that you have just deliberated. So, Ankit ji, there is one very significant portion, and the main question is related to inclusion of significant financing component. So, as you have rightly mentioned, Ind AS 109 clearly says that if there is no significant financing component, then the initial recognition of trade receivables is required to be made or is required to be presented at the transaction price only. So when you see para 60 to 65 of Ind AS 115, it talks about significant financing component. One such example is, see, when you go to para 63 of Ind AS 115, it gives you a practical expedient when the transaction duration say is less than 12 months. In that case, the company can use that practical expedient and can treat that there is no significant financing component included in the particular transaction that has taken place. The other point is, Ankit ji, related to the provision metrics. I think it is one of the main and commonly found pitfall that we have seen in almost all companies, that they are mentioning that they are using the ECL approach, they are using the simplified method. Correct. They are reviewing the credit risk at the end of each reporting period. But on the other side, when you come to the disclosure of provision metrics, they are not disclosing the same. So interestingly, if you remember about that particular company, when we asked them, they said that we have businesses in different demographies. So the risk related to different demographics are different. So the kind of parties are different. So we are not able to, and the Ind AS doesn't require us to disclose the provision metrics in such cases. And it is clearly mentioned in Ind AS 109 that whatever the situation may be, if there is different sort of risk associated with different business segments or different demographic related receivables, you need to give the provision metrics accordingly for each such segment or each such demography. So in any case, the disclosure provision metrics is compulsory. Coming on to the next commonly found pitfall, it is related to disclosure of related party transaction. Ankit ji, if you would appreciate this fact that when we see the commonly given observations of FRB or FRQRB or NAFRA, you say these observations are majorly related to related party transactions, corporate governance, financial instrument, and revenue recognition, which, as you have rightly mentioned, after the notification of 29th of March, people are widely aware of what was the issue during the presentation of revenue recognition or the accounting policy. So when we talk about Ind AS 24, para 18 of Ind AS 24 requires the entity to disclose the related party transactions in detail. So say examples, this was an example of a financial statement of a company where debentures were issued by the holding company to the ultimate holding company. So when you see the section where the transaction between holding and subsidiary or holding and ultimate holding company is given, they have given that particular transaction in that place, but they have not included the same in related party transaction. Adding on to this particular disclosure related point, NKG, when there is a transaction between two related parties, say the transaction relates to a loan, like a related party has given the loan to the company. So what we have seen, the companies are disclosing the opening balance, the closing balance, and the interest paid during the year. But it is clearly given in the Ind AS that other than this opening, closing, and the interest paid, you are required to mention the terms and conditions of that particular transaction. You are required to mention the repayment period also. So this is, I think, the commonly found pitfall which you all, after conclusion of this seminar, when you see your company's annual reports and any other annual report, you will see that the companies are disclosing limited details related to outstanding balances or say the interest paid or received. But when it comes about disclosing of nature of transaction or the repayment period or any other terms attached or related to that particular loan transaction, the companies are not disclosing the same. So Ankit ji, can we move on to the next point?
Correct.
Or
No, I will not. No, I will not allow you to move on the next point. I had a question with our
Yes.
audience, and that question
Sir,
still
we
remains
have-
to be pending.
Sir, we
Right,
have
Saloni.
received the response for your question, and one answer is yes, and the another is replied Sharad Agarwalji from Gwalior that if credible reports in the media and the press come out on banks and NBFC or FDs, then surely it will give some direction for treatment.
Okay, so I think yes. The answer is yes. There is no confusion regarding it. As a part of your accounting policy or as a accounting SOP, we should have this practice of evaluating credit reports. What the other Mr. Sharad Agarwal was saying. Also, the credit ratings of these banks. So, if a credit rating goes significantly down, then there has to be an impairment allowance based on the credit reports received of these deposits or something like that. Importantly, we should talk about these policies, the policy of impairment of other contractual assets. We should not say that we don't have a policy of impairment of bank deposits or they are a part of a public sector bank. The deposits are a part of it, irrespective, even if it is NFRA issued advisory. Kuldeep, if you recall, that entity had a bank with SBI Consortium Bank, and the reply they submitted to NFRA was that we have an account with SBI Consortium Bank. Thus, we did not feel the requirement of providing for impairment allowance on it. So make sure that these policies are absolutely in alignment. Also, you were discussing about related party, Kuldeep ji. a lot of these companies have public sector enterprises have independent directors on their board,
Hmm.
and they pay their sitting fees also. While Ind AS 24 clearly mandates, how these sitting fees needs to be disclosed, or how I and Saloni had a very, very long discussion on this entire, and the compendium also, our latest compendium also talks about this case study, wherein if you are paying to your KMPs, then how do you disclose as per Ind AS 24 the remuneration to KMPs? The problem is that some companies Ind AS 24 clearly mandates you to disclose it on 5 fronts. One is the short-term benefits, one is the other long-term benefits, one is the deferred benefits, right? There is no mandate of disclosing the sitting fee. The sitting fee is a part of short-term benefits and needs to be disclosed there itself. Irrespective, this sitting fees is paid to an independent director. Importantly, why as public sector enterprises or these companies gets confused that they think that we are talking about KMPs, so or the employee remuneration, and independent directors are not employees. There is a clear clarification in our compendium also, latest compendium which Saloni has recently issued, and and also the ITGC Council, that the remuneration needs to be bifurcated into these 5 clear parts. Irrespective, if there is no remuneration in any of the part, you can write, you can leave it blank, but manage your remuneration, KMP's remuneration, into the 5 parts which are told by Ind AS 24. Over to you, Kuldeep ji. Again,
Ankit, one more thing I would like to add on to this particular disclosure of payment to independent directors. What we have seen in the financial statement, that the companies are disclosing the fees paid to independent directors under the head of other expenses. So as you have mentioned that it is to be disclosed
correct.
subheads, the same is required to be included in the employee benefit expenses instead of disclosing it in the other expenses. This was the common, I think, almost, if you see, 9 out of 10 companies are disclosing the sitting
9
fees
out of
paid
10.
Yes,
9
yes,
out of
in
10.
the same way. So the next commonly found pitfall is related to 116. It is related to leases. When you see that this is again, it was the index which was very widely talked upon, and when it was implemented few years back, everyone was working on this. When you see the disclosure related requirements, you will see in the financial statement of the company's right of use of assets or the finance cost on account of leasing activities. These things are disclosed properly. So when you come on to the accounting policy part, as we have spoken previously also, that the major pitfalls which we have seen, the major problem statement which you have seen is related to accounting policies or the disclosure related requirements. So when you see that there is a very common disclosure which is given other than the right of use of assets or the interest cost on account of leasing activities and all the notes to accounts, there is a very common disclosure which is given. There is no quantitative or qualitative details about the leasing contract is being disclosed by the companies. Say if there is any lease back or buyback related clause is given in the leasing agreement after the end of the lease, any covenants or any sort of restrictions or specific conditions which are attached to the leasing agreement, such disclosures are missing when you see the accounting policy related to Ind AS 116. Anything you would like to add to this, Ankit, or can we move on to the next point?
Correct.
Can we move on to the next point, Ankit?
Kuldeep ji, the host, I think the PPT is run through.
Pardon?
I am unable to hear you.
Is the screen
There is
visible?
some voice lag.
Saloni, the screen
Yes,
is
yes.
visible.
Now the screen is visible.
Okay. So I would request you to move on to the next point related to netting off of disclosure while presenting the cash flow statement or statement of cash flows, to be precise.
Right, statement of cash flow. So all the proceeds which are from your repayment of term loans, or
I have purposefully written this cash flow statement here.
right. So if you are complying to Ind AS, it is statement of cash flow. Also,
Exactly.
the proceeds, the repayment, right? The Ind AS 7 clearly states that if there are some cash flows arising from operating, investing, financing activities, they may be reported on net basis if the conditions are met. So, but there are specific conditions to it. Every time you can't report it on net basis, you can report it on the gross basis also, on gross, and you should report it on gross basis. That is something which I would want to add here. Kuldeep ji, anything you want to add, or we can
Maybe
move
we
on
can
the
move on
next?
to the next points because we are running
Because
short of time
we
and
are
we need to
really
cover.
short of time, right?
So
Sir, we
I
have
think
received a
these points-
query.
Go ahead, Saloni.
Yeah, here it is asked by Rohanji. Sir, we have leased plot of land from JNPA for 60 years. How should be the lease amount paid be disclosed under Schedule 3?
I think the lease period of 60 years will not be covered under long-term lease. So it is required to be, bifurcated into right of use of asset and the finance cost part based on the discounting rate that they are using. Generally, the people use the rate, which is being given on the FDR of a government bank or 10% say common rate. Ankit ji, anything from your side on this?
No, the right to use and everything needs to come, right? The company
Because-
should clearly mention.
Why I'm
Please.
able to recollect to this particular point, we had the same point in our client's case also a few years back, but the lease period was 90 years. So when you see the literature which is given along with the statute, it talks about lease period of 99 years or more. So when we discussed at that time, we had taken a legal opinion from an expert, a legal opinion from a lawyer regarding the same, that the lease period of 90 years can be treated as a long-term lease. So in that case, we have included it in the PP schedule. Else, if the lease period is, say, in the given case, as Rohan has asked, 60 years, in my opinion, it should be, disclosed under right of use of asset and the finance cost.
Correct. We can move on the next point.
These points, I think, we'll cover in the NAFRA observations, Ankit ji. So we can move on to the next part, if you permit.
Sure, please.
So these are the, when you see presentation of a financial reporting statement, or you say annual report, we dissect the same into 5 sections. Ankit ji, first is chairman's report and director's report. The other section, the second and most important section, is management discussion and analysis. Third is corporate governance. Fourth is financial disclosure of financial statements per se, about which we all are very much aware. And the fifth part is other disclosure related requirement, which may include value added statement, ESG related
The
reporting, or BRSR. So Ankit, over to you for the chairman's report and director's report portion.
Right. So what Kuldeep ji has bifurcated, and Saloni is also here. So this is the bifurcation based on the ICI report on excellence also. And all these 5 sections have different weightages. Previously in the session also, Kuldeep ji talked about MDA. And this MDA in last few years, we see very compromised after the integrated reporting framework coming up. It constitutes more than 14 to 16 marks out of, if there is a 100-mark evaluation. So a lot of companies, Kuldeep ji, while we should also talk about the ICI awards also. A lot of companies only submit their annual reports and financial statements. It is an entire annual report which needs to be enhanced. And from a chairman's director report, everything constitutes a marks. Your vision statement, your mission statement, whether it is there or not, whether there's a chairman's speech there or not. Public sector enterprises misses sometimes to take their chairman's speech. What are the constituents to the chairman's speech? Whether the chairman's speech talks about the numbers, the EBITDAs, the PATs, the critical numbers pertaining to the company or not. Whether a chairman's speech has a forward-looking statement aligned to it and the future plans, The chairman's speech should talk about the future plans. All these things, if in a chairman's speech, will fetch you 3 to 4 marks. That's how the tough this evaluation is. And that is why every front needs to be worked upon, besides not only working about, the accounting policies and disclosure. Yes, being chartered accountants, it is important, but now the versatility of the profession expects us to, work on the other fronts also, which are a constituent to the annual report. Initially, Kuldeepji, this was for a long duration looked by the secretarial team, and still a secretarial team looks after the non-financial sections. To all CFOs sitting here, I would say now, your secretarial team will need the help of a chartered accountant to, draft all these sections in compliance, not only to LODR, but for an excellent financial reporting practice. So one, the chairman's speech, director's report needs to be, in the way in which I deliberated, or we tried to deliberate with you. The second portion is a management discussion and analysis. And I told you it constitutes 14 to 16 marks. A lot of companies fail to do their segment reporting properly, especially public sector enterprises. They are not disclosed very well. Importantly, I'll tell you there's a format to MDA, and why I told you that after integrated reporting coming, and MDA is compromised. I will show you an annual report, Kuldeepji, where it is written management discussion, analysis, and financial capital. So that has come out. And when such things happen, so that the section talks about management discussion, analysis, and financial capital. The company aligning with integrated report have started merging integrated reporting sections with MDAs. There are two different sections. MDA is a statutory report. I'll tell you some commonly found problems with MDAs of public sector undertakings. One, the problem which is written here, which pertains to enterprise risk management framework and benchmarking this framework, whether we have benchmarked in a tabular way or not, whether it is benchmarked to the global practices of ERM 2017 or not, whether the risks are categorized based on the risk assessment process of an entity or not. So entire section needs to be covered. Some missing sections in public sector enterprises report is the human resource section, is the opportunities and threats section. Sometimes these sections come up very generic. If you are writing an opportunity or you are writing a threat, you are also expected to write the response to that opportunity or response to that entire threat. So these things, then your internal control mechanism, the policies of internal control, talk about your in-house teams if working on internal audits, talk about the external consultants, talk about the metrics, talk about the quantum of compliance you have done under an internal control policy. The problem with public sector enterprises annual reports is in 4 or 5 years, these sections have not changed. And that is why, I am putting a great emphasis on these sections, that the time has come that they should be benchmarked to the best of the practices, and they should do the compliance part also. Like Kuldeepji was discussing, while there's a change in more than 25% of a ratio from 1 year to the previous year, then that needs to be separately disclosed. So with integrated reporting coming up, please don't compromise your management discussion and analysis section. The third section talks about the corporate governance section, and there are some forward-looking disclosures which should come out as a part of an excellent financial reporting practice, be it a disclosure on the Code of Security 2020, the impact assessment of the new labor code. In PSUs, Kuldeepji, this point is specifically found where there's a significant non-attendance in board meetings or audit committees by a director. The reason for non-attendance should come out well, should be disclosed, right? Then obviously, the related party disclosures also needs to be undertaken under the corporate governance report. Anything you want to add on corporate governance front, or any an MD or chairman speech front, Kuldeep ji?
Ankit ji, as you have already covered, but I would like to add one thing that when you talk about MD and integrated reporting, you have rightly mentioned that after the implementation of integrated reporting, these two things are getting mixed by the companies when they are failing to appreciate that management discussion and analysis is required to be presented as per regulation 34(2)(e) of SEBI LODR. So it is an compulsion, statute driven compulsion, which is there in which is there for the listed companies. So in any case, you should not mix the MDA section with the integrated reporting. You have already covered the commonly found pitfalls related to the risk management or the segment-wide performance, which is there. When you talk about corporate governance, Ankit ji, one point that you have covered, that we have seen that there is major non-attendance on account of independent directors or other directors in board meetings in few of the companies, because generally PSUs or the public sector enterprises are driven by the regulating ministry also. So sometimes it is due to the regulatory process, the appointments or the replacement related issues gets delayed. So in one big company, we have seen that the post of women independent directors or the director was vacant. It remained vacant beyond the reasonable time. So it was an qualification which was there in the secretarial report also, but the company failed to disclose the appropriate reason of the same non-appointment in the corporate governance report. Over to you, Ankit ji, for the financial disclosure part.
Kuldeep ji, just one thing, right?
Sure.
I think the experience of directors is also coming repetitive.
Yes,
So
yes.
make sure that it is a part of a corporate governance report. Not necessarily you should come in the beginning talking about the experience. An excellent financial reporting practices showing the strength of the directors, cumulative strength of the directors. Sometimes you can come out with cumulative experiences. Sometimes you can come out with versatile profiles of these directors. With financial disclosure, I think we have enough discussed financial disclosure, and we will discuss the NAFRA observations, in times to come. Kuldeep ji, while MDA has been discussed, I would straight away want to discuss the integrated report aligned to the MDA section, so that somebody can, distinguish between what basically an integrated reporting is, and also this entire integrated reporting in public sector undertakings is negligible. I saw, companies like BPCL and HPCL also not making this, rather they are the biggest companies, and I am sure that in times to come, one would make it. But in case we can discuss an integrated report of a public sector enterprise, maybe NTPC is doing it. If you have an annual report of NTPC, I would want to quickly run through the integrated reporting framework of NTPC. The idea is just to give you an overview. By the time Kuldeep ji is sharing, I would just want to brief you that, the integrated reporting framework is a voluntary adoption framework. But once you adopt voluntarily, then you can't go back on your routine annual reporting framework. You have to then continuously publish your report as per the integrated reporting practices. This is a framework which is benchmarked with IIRC, which is International Integrated Reporting Council, which was, I think, formulated in 2012 or 2013. And they have given a clear framework, 13. The problem with Kuldeep ji, I think, with not only public sector enterprises, even NTPC has done it. And they have, I would want to congratulate them for, at least being one of the first movers in preparing integrated reports. But there's a lot which could be enhanced on integrated reporting front, specifically quantifying all the 6 capitals which are coming out in integrated reporting framework. Kuldeep ji, I am still unable to view your screen because there's a lag. I am sure audience can see that.
Saloni, is it visible?
Yes.
Yes, sir. Screen is visible. It is showing our value chain.
Okay.
Okay. Kuldeep ji, can we move on? Can we move on the value creation model to all the entities who have not prepared integrated reporting framework? You lose a substantial marks from this year onwards. There is a specific weightage which is being given to value creation model, and that should come out. also there should not be any confusion in showing your value creation model and showing a value added statement. These are two separate things carrying two separate weightages. So this integrated reporting framework is bifurcated as per IIRC Council. You can see this PDF file into 6 capitals: your manufacturing capital, your intellectual capital, your human capital, your natural capital, your social capital. I hope this is coming out right. Now, what you need to depict in an integrated framework is the value chain which all these 6 capital creates. So, what is an input to these 6 capitals? The company's value chain model. If NTPC people are here, my request will be that this value chain model can be reworked to major. NTPC is a major player. Is one of the best players, I would say, not the major player, but the best players in the segment. And the value chain model can be created in much better way. But I like that they have been able to quantify these capitals. Even the largest conglomerates do not quantify. They define these capitals. So an integrated framework talks about 3-4 things. One, please introduce these capitals to your stakeholder. Talk about these capitals. Do a materiality assessment, which is compulsorily to be done as per IIRC framework. Talk about what are the material aspects for each capitals. Then you talk about the inputs. For example, in financial capital, here we see the input as debt. Even though when financial capital is defined later, Kuldeepji, NTPC has talked about equity and reserves, I guess. But in this value creation model, you can't miss equity, debt, as well as the retained earnings which you possess. Now, the value adding element cannot be 12 subsidiaries or 16 joint venture, right? Or a business line of consultancy services. This can't be a value adding activity. The value adding activity to financial capital is just not in alignment to what we were expecting. And then comes the output of it. Try to make it a 2-pager value creation model coming together so that the input, value creation model and output can clearly be defined. With intellectual, NTPC has done fairly well, right? They are talking about their amount which they spent at Netra, right? Their R&D, their labs, the number of labs, their L&D institute, right? They are reasonable. The dedicated consulting wing is not a part of intellectual capital, sir. But the digitization strategy can still be a part to it. So I think in terms of quantifying the capital, NTPC has done very well. If Kuldeepji, you can scroll down a little bit. In manufacturing capital, talk about your plant locations, the number of plants you have, the backward and forward integration you are able to do, like NTPC talked about their backward integration of their own captive coal mines, right? The capacity is extremely important, which we should talk about, right? But in output, make sure that your output also comes parallel to all these 4 or 5 things, right? Kuldeepji, if you can move slightly downside, and if I can explain the users.
You are talking about the output of this value creation model, Ankitji?
I am talking about the other 3 capitals which I am not able to see. I am only able to see the financial, manufacturing and intellectual capital, the natural, social and human capital.
Human, natural and social is visible on the screen as of now. Are you able to see it now, Ankitji?
Not yet. I am telling you, yes, now I am able to see a slide. So human capital, the number of training hours, the number of, manpower you trained in a year, right? The quantum of your employee remuneration, your perquisites, everything can be a part. So make sure that this is a very basic framework with which NTPC has come out, but we should give them full marks for at least coming out. Right. We should, and no company can straight away come out and jump on a most, best of the model. So naturally, the human capital, your natural capital, your social capital, everything needs to be well defined. I am a believer that your value chain, if you are able to create this value creation model well, I think the engagement will stakeholder with integrated reporting will increase. Now here also, since we talk about these 5-6 capitals, the problem is while we link it to MDA, so people don't talk about their human resource policies or their
In the
environment
MDA section.
policies or right. And
Mm.
so in case you feel that it has been a repetitive data,
Mm.
you can take that risk of not risk, but you can take an initiative of linking your report well. So
Cross-referencing.
if you don't want to be repetitive, you can use navigators and link this report. So I hope with this we are able to bring some clarity on what an integrated reporting framework is. While introduction to the capitals, please ensure that materiality assessment is also done. Kuldeep ji, over to you. Over to you. I think you can discuss the LODR thing now.
Yeah, sure. My screen
Are
is
there
visible.
any? Yes, your screen is visible. Are there any questions pertaining to integrated reporting framework? Please let us know.
Sure, sir.
So can we start with SEBI LODR, Ankit ji?
Sure.
So basically, as you all are aware that recently SEBI has amended the SEBI LODR regulations twice in this particular year. I think Neha will also appreciate the same, as we have worked closely on the particular issue extensively. So first notification came in the month of January, and the second notification, which I think amended the guidelines to a larger extent, came in June 2023. And the notification which came in June 23 clearly states that these amendments are effective from 14th of July 2023. So as of now, on all listed companies, these amendments are applicable. So the major changes or the major amendment which took place in the SEBI LODR regulation are related to materiality, the concept of materiality, disclosure of various events, whether occurring from inside of the company or whether it is a clarification related to market rumors, related things, fulfillment of any vacancy in the office of KMPs. So we'll try to cover in next 5 to 10 minutes precisely all the amendments which came in LODR, because it requires a separate deliberation of 2-3 hours if you want to cover it in detail. So the first insertion of the first new thing which was added to SEBI LODR is defining the mainstream media. If you see that in the present time, they are very scattered informations which are available online, which are available on the news channels, be it a online news channel or be it a channel which is aired on the television, also in newspapers or in other social media handles also. So what SEBI has observed is that these, in some cases, these particular news or these particular threads or bots were used to impact or used to inflate the price of the shares of the company. So the SEBI has defined mainstream media. What is a mainstream media? Mainstream media is if you talk about newspapers, it is an RNI registered newspaper. If you talk about news channel, if any channel or any channel which is broadcasted and which is permitted by the Ministry of Broadcasting, the Government of India, is a valid mainstream media, which is treated, which is defined under Regulation 21A of SEBI. If you talk about online channels, Nehaji, as we have discussed, if any online channel or social media channel, though it is not clearly mentioned, the SEBI has come up with a clarificatory notification also, and they defined that if any social media handle or channel, if it is having any sort of impact on the larger public. So if you see that if any information is given on a social media handle or social media channel or a YouTube news channel which has say 100, 200 or 300 followers, so in my opinion it is not a news channel which can have a material impact. On the other side, if you take the example of ICA. If the ICA is running any YouTube channel and it has followers in lakhs, like 1 million or 2 million, and if the same news channel or news handle is publishing anything, then it will be treated as a mainstream media. So it is correlated with issuance of clarification of market rumors. So with these amendment notification in SEBI LODR, SEBI has mandated for the top 100 companies to clarify if there is any market rumor related to those companies which is floating in the mainstream media, and for that very reason, to curb any sort of ununiformity or any sort of disputes, SEBI has defined mainstream media. The next insertions which was made is related to vacancy in office of KMPs and directors. So basically, in all these amendments or the insertions, SEBI has said that no such office of any KMP, like a compliance officer or a CFO or a CEO or any director, should remain vacant for more than 3 months. The next amendment is related to appointment or ratification of appointment of board of directors. Previously, before insertion of this notification, this regulation 17(1)(d), there was no such mandate on the companies that any appointment of board of directors is required to be ratified in every 5 years. So with effect from 1st April 2024, if any reappointment of any board of directors is being made, then it is required to be ratified by the shareholder in every 5 years. Next is related to the regulation 27, talks about if any cyber security related breach or any threats has come in the knowledge of company, any loss of data has taken place, then the same is required to be included in the corporate governance report. So it is very important for the company secretaries also, and it is required to be reported to the exchange at the end of each quarter. The next and the main amendment which has taken place is related to mortality, Nehaji, and I think Ankitji's connection is lost due to some technical glitch. So it is related.
Yes, sir.
It is related to the concept of mortality. Previously, before this amendment, there was only subjective, or you say qualitative details or qualitative threshold was given for the identification of material events, be it on the basis of the materiality policy that the companies were following, or in the Schedule 2 Part A and B, there were some events which were deemed to be material events. So before this particular amendment, there was no quantitative threshold which was given, and it was leading to discretionary uniformity in presentation of material events. So post this particular amendment, what SEBI has done, SEBI has put in a quantitative threshold. So the first threshold of quantitative limit which SEBI has produced is 2% of the turnover. If any impact of the event which has taken place is more than the 2% of the average turnover, then it is required to be reported. Turnover is to be taken on consolidated, not on standalone basis. The second threshold limit is related to net worth. If any impact of event which is being tested for the materiality part, if it is more than the 2% of net worth of the company, again it is consolidated net worth of that company, it is required to be reported. And the next and the last threshold which the SEBI has declared is 5% of the average absolute value of profit and loss after tax in the last 3 audited consolidated financial statement. What absolute means here is that if there is any loss in any of previous 3 years, it has to be added while calculating the average limit. So say you talk about financial year 23-24. In 22-23, you have profit of 10 crores. In 21-22, you have a loss of 8 crores. And in 20-21, you have profit of 10 crores again. So for getting out this average, you need to add on 10 plus 8 plus 8, 28. So this is the meaning of absolute value of profit and loss. If there is a loss, it is not required to be subtracted from the profit. It is to be added in absolute value, and then the average is required to be calculated. So there is one interesting point in this particular concept of materiality. When you see the quantitative threshold, the clarificatory notification of SEBI mentions that whether the impact is in terms of monetary value, whether it can be quantified, and the other is in terms of impact on the qualitative part. In both cases, it is required to be reported. So say if you are entering into any transaction, say if you are installing any plant and machinery, so it is in addition to your property, plant and equipment, but the value of that particular addition is not as such, which is covered under this particular threshold of 2%, 2% and 5%. On the other case, in longer term, the impact of that particular addition to your property, plant and equipment, your manufacturing facility, will result into a change of profit or the top line, say turnover, and that particular impact is more than these threshold, then in that case also it is required to be reported as a material event to the exchange. Recently, when I was going through the limited review of one of my clients, Neha, what I have seen is that they entered into an agreement with a foreign entity for manufacturing their particular product. That particular MOU was entered on 5th of July. They were saying that it is a trade secret and hence we will not disclose the same. Later on, we found that that particular company was listed on the stock exchange of their respective country, and they've already given the information on their stock exchanges. So in that case, their question was that they had two questions. One question was that since the event is related to a date which is before 14th of July, do we need to disclose it? And second, it is a trade secret. So there is a clear-cut answer which is given by the SEBI in the clarificatory notification, and what we have identified by our reading also, that be it before 14th of July, there was a threshold of 24 hours. So in any case, if there is any material event, it is required to be reported. And second is it is already reported in the prominent news channels or online media. It doesn't remains a trade secret for you when the other counterpart has already given this disclosure to their respective stock exchanges. It becomes mandatory for you. So as per regulation 34, it says if there is any material event which has taken place before the date of implementation, that is 14th of July, then you have 30 days for disclosure of that event if it is identified after the implementation. But in this case, Nehaji, this event was already identified, and in this case, the rule of 24 hours will apply, and hence the company was at non-compliance of SEBI LODR regulation. So moving on to the next part, which we have already discussed about materiality. Now on, if there is any information or any decision which has taken place from a board meeting of a company related to any event, it is required to be disclosed within 30 minutes of that particular board meeting, after the conclusion of board meeting. If there is any information event or any news which has arisen out of the internal working of that company or the company itself, then the threshold is 12 hours. And if it is related to the market in which the company is operating, then it is required to be reported in 24 hours. So the SEBI has clearly, dissected the kind of event or the kind of information and the time limit which is given, and it is required to be strictly followed. Next proviso is related to regulation 3011. We have already covered that the top 100 listed entities from October 23 and the top 250 entities from April 24 are required to clarify any event or any rumor which is floating in the mainstream media within 24 hours. So what practical issues the company will face, any listed company will face here, is that identification of this material event or information. In my opinion, and as far as what we have discussed during our deliberations also, Nehaji, I would like to bring it into the notice of the secretarial team of the companies and the KMPs who are sitting in this webinar, that you need to have a clear-cut SOP, standard operating procedure, to identify these sort of events, because in case of companies who are having hundreds of branches or turnover of more than, say, thousands of crore, it will not be possible for them to, without having a SOP, identify each and every event, to keep a track on each and every event. So I think for this case, or identifying these material events, they may have a separate designated person or they can create a digital checklist or digital SOP kind of thing, which the KMPs can pass on to the senior management personnel or the function head, and on every month or quarterly basis, they can take the reporting from them, and based on that particular reporting, whether any event has occurred or not, they can submit the information to the stock exchanges. So they are also complying with the responsibility which is entrusted upon them after these amendments. So the other point is defining of materiality policy. When you see your company's materiality policy, I'm talking to the audience who are attending this particular webinar, or you see the materiality policy of any other company, you will see a very generic sort of materiality policy. It is based on the discretion of the board of directors, or very few events are mentioned in that particular materiality policy. But post this implementation, post this amendment, the companies are required to amend their materiality policy also, and this particular amendment will be a overhauling of the materiality policy which the companies are presenting or disclosing as of now. So the first question which will come in your mind is that till what time we can amend our materiality policy post implementation of these amendment regulations. So there is no such specific date which is mentioned by the SEBI to till what time you can amend your materiality policy. But if you go by prudence, if you go by understanding of the consultation papers which was there, you see that maybe after the conclusion of the first board meeting which will take place after these amendment takes place, like 14 July, if any board meeting takes place within few months of that particular effective date, 14 July. So maybe in one board meeting or the other board meeting, 2 or 3 months, you need to amend your materiality policy in reasonable time. It doesn't mean that if no such regulation or time is mentioned, you can take 6 or 8 months for amending your materiality policy. Maximum up to 1 or 2 board meetings, which will take place after the implementation date, which is 14th of July. So I think sufficiently we have covered related to materiality. So since we are having paucity of time, I would like to conclude here only. I would like to thank the research committee, our honorable chairman Anuj Goyal sir, vice chairman Kotha Srinivas sir, and dynamic secretary Amit Agarwal sir, and Neha ji and your team. I think we as a speaker, it was our duty to deliberate upon these topics, but you did your job fantastically. Relentlessly, you communicated or coordinated for the past few months, and because of the efforts of you and your team, it has been possible. So I would hand over the dice to you to say a few words before we conclude this wonderful journey of knowledge sharing. I think without your support and without the support of my co-speaker Ankit ji and the other team, it wouldn't have been possible. Over to you, Neha ji.
Thank you so much, sir, for your wonderful insights and knowledgeable session. And thank you so much for making session such interactive. And on behalf of the research committee, I would like to thank and extend my warm gratitude to our esteemed chairman research committee, CA Dr. Anuj Goyal sir, our vice chairman research committee, CA Kotha S. Srinivas sir, and both the speakers for today's session and for the entire series of the webinar, CA Ankit Maheshwari ji and Kuldeep sir, obviously, who are the subject matter experts and have given us their time out of their busy schedule for sharing the knowledge with the participants. Also to Dr. Amit Kumar Agarwal, Secretary to the Research Committee, for idealizing this entire series of webinar, which exactly serves to the need of the professionals. Finally, a great appreciation to all the participants for staying connected with us throughout the entire series happening since last 3 months. And before concluding the today's session, I would like to take all of you through the journey of the entire series of webinar, in which we have started with the manufacturing sector, covering service sector, banking sector, insurance, financial services, NPO and municipal bodies, infrastructure and construction sector, and today, obviously, the public sector enterprises. We have learned that both the financial as well as non-financial information are important aspects of annual report of any of the organization. We also learned about various key sections of an annual report, which are chairman, director's report, management discussion and analysis, financial disclosure, corporate governance. We also got to know about the common error which are made in these sections and what would be the correct way to report in these sections. We also took a closure look on evolution of the annual report in the last decades. Key transformation that happened were digitalization, focus on ESG targets, interactiveness, BRSR reporting, introduction to 6 capitals, future strategies and goals, enhanced disclosure, and so on. We got information regarding various quality controls at ICAI like peer review board, financial reporting and review board, tax audit and quality board. We also discussed regarding the top pitfalls in the financial reporting and disclosures like sensitivity analysis for market risk as per India's 107, intangible assets under development, initial recognition of trade receivables as per India's 115, Schedule 3, and various other aspects. We also discussed about the external or regulatory mechanism which are applicable to the companies in India like SEBI, MCA, RBI, and other regulatory bodies. And the highlights of for revamping the financial framework was the need of the hour that was discussed during the entire series. Once again, thanks to both the speakers for making the sessions very interactive and clarifying the doubts and answering all the queries that has been received from the participants. I hope that all the participants have enjoyed the sessions, and recording of all the sessions are obviously available on the ICAI TV, and all can refer to that. Lastly, I would like to mention that the journey of learning keeps going on. So wish you all a very happy learning.
I would like to add one thing before we conclude, Neha ji, that on behalf of my co-speaker and my partner Ankit ji, I would like to reciprocate and express my gratitude towards research committee and the audience who have, patiently traveled this journey along with both of us. And if you all have any sort of questions, you can reach out to the research committee, or you can reach out us on LinkedIn also. And I would request you and your team to organize more such webinars on specific topics like integrated reporting, or say ESG, or SEBI LODR maybe, so that the participants can be enlightened more about our practical experience and the research work that we are doing. Over to you, Neha ji. Thank you all for
Definitely, sir. Definitely
being part of this wonderful knowledge sharing journey. Thank you.
Thank you so much, sir.
Thank
so with this, I think we can conclude with today's session.
Sure. Thank you. Thank you, everyone.
Thank you.